Thank you, Maria. Well, the first thing you're going to discover is that I had no idea what she was just talking about. And my apologies for not being able to speak your language, even though this is my third trip to Lithuania, so I really should be doing much better than I currently am. It is a pleasure for me to be here with you today. This is my sixth day in Lithuania, and this is the last lecture I'm giving out of 13 presentations I've made this week. So if I get a little tired in the middle, I hope you understand. As I think was just mentioned, much of my work involves examining the ethical and moral dimension of economic life, not just in the United States, but in Europe, but also Latin America and Asia. And much of my time has been spent looking at questions of banking and finance. In fact, I wrote a small monograph about 8 years ago on this very subject, but that was before the financial crisis. And if I was writing that same monograph today, I would probably change some things. Because my subject matter this morning, which is banking, justice, and the common good, there's a subtitle to it. The subtitle is A Retrospective Analysis of the 2008 Financial Crisis. Now, we're living, of course, almost 5 years now since the worst financial crisis to afflict the world since the Great Depression. And I do think that the financial and banking sector has learned some significant things, but I also think that there are some lessons that were not learned and have not been learned. And today I'm going to look at this ethical dimension of the 2008 financial crisis and suggest to you that alongside some basic economic problems, that some moral and ethical issues were also involved. So let me begin with a famous sentence that I suspect many of you are already familiar with. And the quote is this: "Little else is requisite to carry a state to the highest degree of opulence from the lowest barbarism, but peace, easy taxes, and a tolerable administration of justice." Who knows who said that? Okay, it was Adam Smith. These words come from Adam Smith's Wealth of Nations. And I think they describe very much what are the necessary and essential preconditions for widespread economic prosperity. Please, come in. But I think that if the 2008 financial crisis teaches us anything, it should also be just how much the workings of the market economy, of market capitalism, just how much it depends upon people adopting and living some rather uncontroversial moral virtues. Interestingly, I think Adam Smith himself always understood this, and I'll say more about this at the end of this presentation. But this is why I think it's very useful, if you're going to read his Wealth of Nations, the 1776 Wealth of Nations, I think that should always be read in light of his 1759 book, which was, of course, the Theory of Moral Sentiments. Now, back in 2008, I suspect many of you will remember we heard a lot of talk about the effect of greed on Wall Street and greed all around the world, and how this was part of the financial crisis. And yet, despite that, I think it's still rare that you find analyses of the financial crisis that take the moral dimension seriously. But let's just keep in mind just how much damage to, let's call it the common good, was done by the 2008 financial crisis, especially in the United States and Western Europe. Beginning back in August 2005, which is when the financial crisis really started to manifest itself, we started seeing banks and financial houses enter bankruptcy. Back in 2008, the US Federal Reserve assumed an 80% stake in America's biggest insurance company to prevent it from going bankrupt. The mortgage lenders, the very big government enterprises, Fannie Mae and Freddie Mac, you'll remember, were taken over by the United States government. And financial institutions in America and Western Europe wrote off billions in dollars and euros when it came to losses. In both America and Europe, governments assumed very large stakes in banks. And in human terms, just in human terms, something like, we now estimate, something like over 200,000 financial sector jobs across the world just disappeared. People's careers were shattered. I can remember very well giving a talk in London in October 2008, the day that Lehman Brothers collapsed. And I was at the London Business School, and there were people in the audience that day who had lost their job as a consequence of Lehman Brothers collapsing. Now, of course, since then, lots of financial analysts, lots of people who write on economics and finance have engaged in plenty of analyses to try and explain what happened during the 2008 financial crisis. And they've primarily looked at it in strictly economic terms. So when you read some of the literature, what you find are phrases like this: overexposure to high-risk investments, suspension of withdrawals from funds invested in illiquid credit securities, and margin calls forcing hedge funds to liquidate good assets. These are the types of expressions that dominate the discussion and analyses of the 2008 financial crisis. Now, all of these expressions and others, of course, have real meaning. They accurately describe some of the factors that were at work in the financial crisis. But what I think much of the language of these commentaries distract us from is from the human dimension that's involved. Because just like any other element of the market, banks and financial entities don't consist of faceless entities. They're not made up of anonymous group dynamics. Real human beings, real actions, and real choices are at the heart of the financial system. In other words, real people who create wealth, who respond to incentives, who make honest mistakes, and sometimes behave irresponsibly, sometimes even immorally. Now, as you all know, there's no one single cause of the 2008 financial crisis. Some of the candidates who rank very highly when it comes to explanatory factors include things like loose monetary policy by the Federal Reserve, massive bank over-leveraging by banks in Europe and the United States, and of course the American subprime mortgage implosion. But this morning I'm going to focus on two aspects of the problem which I think illustrate some of the moral elements that were at work. First of all, I'm going to look at monetary policy and mortgages. The second thing I'm going to do is look at failures in the securities rating industry. And then I'm going to conclude with some remarks about what I think the 2008 financial crisis teaches us, and especially about whether we like it or not, that the very practice of lending and accepting credit, the very capacity of this to work, depends upon people accepting some very basic moral virtues. Now, before looking at these matters, I want to specify the primary ethical lens that I'm going to be looking at this question through. And one of my working assumptions when I've been studying this area is whether it was things like borrowers lying on their mortgage applications, or lenders neglecting to do the most basic due diligence on their clients, or political pressures being brought to bear to make banks lend money to people who were simply unable to make the payments, or if it was securities ratings agencies who were mired in conflicts of interest. Many of these problems, I think, reflect what I'm calling failures of prudence. And prudence is, in many circles, regarded as the master virtue. It's the virtue that controls all the other virtues. So the ancient Greeks, as well as medieval philosophers such as Thomas Aquinas, they viewed prudence as the cause and measure of all other virtues. It was the charioteer of the virtues, is the expression that they used. Now, prudence Prudence is really about the perfected sense, the perfected ability of individuals to make the right decisions. And this is not something you acquire simply by instinct. This is not something you acquire by reading a textbook. While it's important to understand how prudence works, to a certain extent you also have to live it. Because prudence is the measure of moral virtues insofar as it provides a model of ethically good action. Let me give you an example. A market trader, an everyday market trader, draws upon his experience and all the data available to him at any one moment in time and decides that it is beneficial to sell stock A at 5 p.m. tomorrow and to buy stock B today. Now, the content of the decision, things like the stocks, the amounts, the timing, and the means, this is a product of the act of prudence. But the actual carrying out of the decision may involve other virtues, like fortitude, in other words, courage, doing something in spite of the fact you know there's a risk, or justice, the market trader who does his job properly because it's what he owes in justice to his employer, but also to the people who he supports through his salary. Now, like all the virtues, prudence has its own integral parts, all of which I think have to be present if an act is to be a complete or a perfect act of this virtue. Now, here's the following integral parts of the quality of prudence. First of all, number one, an understanding of first principles. What's a first principle, for example? Don't steal. It's a very good example of a first principle. Second, prudence involves humility. Humility to recognize the true variety of situations that you will experience, the humility that doesn't simply bow down to accepted or popular wisdom, and which involves a willingness to make use of the experience of other people. That's being humble. Third, the third quality of prudence is caution. The willingness to take risks while at the same time mitigating the risks or limiting the risks as far as is possible. Fourthly, comparative reasoning. The willingness to research and compare different possibilities and alternatives. Fifthly, foresight. The ability to estimate whether a particular action will lead to the realization of a set goal. Sixth, memory, an accurate memory in the sense of remembering the truth about reality. You'd be surprised by the number of people who don't want to think about reality. Seventh, shrewdness, and by this I mean the capacity to make a judgment about a situation by oneself and to do it relatively quickly. And eighthly, circumspection. That's the ability to take all the different relevant circumstances into account without becoming paralyzed by indecision. In other words, you look at all the different possible scenarios, but at some point you make a decision. You have to make a decision. You can't be paralyzed by indecision. Now, I think when you think about all those parts of virtue, those 8 parts of virtue, I think you might begin to understand why it's relevant to our situation today and why it's relevant to our subject matter today. Because I think without acquiring or developing any one of those characteristics, I think someone working in the world of finance is either not going to last very long, or they're going to continue to make very, very bad decisions. So, now that I've defined what I mean by prudence, let's move on and talk about monetary policy and mortgages. Now, I think most people know now that much of the 2008 financial crisis owed a great deal to the collapse of the housing bubble in the United States. We also know that the collapse owed a great deal to the massive growth of the subprime mortgage industry and how this began unraveling in as early, actually, as mid-2006. Now, most people know about that, but most people don't know about the connection to monetary policy. There's very little doubt in my mind that the Federal Reserve contributed to the development of this bubble in the housing industry. They contributed to this bubble in house prices by lowering interest rates very early in the decade and keeping them very low. Now, why did this lowering happen? Well, it primarily happened as a response to try and diminish the impact of another bubble which went up, which was the dot-com bubble which exploded in late 1999. So between 2000 and 2003, the Federal Reserve lowered interest rates from 6.5% up to 1%. That meant there was going to be a lot of easy money flowing around in the economy. And they also believed that they could lower interest rates safely because they thought the inflation rate would stay low. Now, the problem, however, was that, among other things, was that the Federal Reserve's inflation numbers were very flawed. And I often think it's said that a good central banker, assuming there is such a thing, a good central banker needs, one of the things they need to do is to be skeptical about the data and to keep questioning the data, if only to force economists to keep verifying the data. But because they failed to do so, because they failed to keep asking the right type of questions, the Federal Reserve kept interest rates low for far too long, thereby allowing a flood of easy money to enter into the marketplace, much of which went into the housing boom. Now, this wasn't simply policy misjudgment, in the sense that much monetary policy today seems dominated by the idea that we need to avoid recessions at all costs, regardless of the fact that sometimes recessions are necessary if we're going to correct imbalances within the economy and to allow resources to be distributed more efficiently. So there is an economic dimension. There was an economic failure to the Federal Reserve's policies. But I think it also represents what we saw happening with the Federal Reserve. It also represents profound failures in some of the qualities of prudence that I just mentioned. Foresight, caution, humility, comparative reasoning on the part of the Federal Reserve. It just wasn't doing these things. Now, similar failures of prudence were also apparent among other players in the mortgage fiasco, most notably those people who were buying and selling mortgages, as well as politicians and governments who were determined to defend the lending policies of Fannie Mae and Freddie Mac, which I always say to people, you need to remember, are government-sponsored enterprises. Fannie Mae and Freddie Mac were not private operators, they were government-operated enterprises. Now, there's a common assumption that the housing market's collapse followed from subprime lending to people who simply couldn't pay back their loans. And there is actually some truth to that. But I also think it's true that a good number of subprime lending went to relatively well-off people who were hoping to make money out of the American housing boom. Now, not only did some of these individuals unreasonably assume that housing prices would rise at a rate of 11% per year, many of them also voided a number of basic elements of prudence. Let me give you an example. Some of you have already heard this. In 2008, a Base Point Analytics report stated that something like almost 70% of mortgage early payment defaulters had made fraudulent representations on their original loan applications. In other words, they lied. They lied about factors like their income, their assets, and their liabilities. It meant that a good number of commercial arrangements, because remember, many of these mortgages were being used as the foundation for an increasing number of securities and equities. So in other words, many of these equities and securities were based upon unsecure foundations because they were based on lies. Lies about people's income, assets, and obligations. Sometimes lies about whether people actually had a job at all. Now, on the other end of the transaction, many banks and other lenders neglected to do even the most rudimentary checks on some of the people who were applying for loans. And to my mind, that means they violated a basic duty of justice towards the owners and management of many people working for banks. Now, in many cases, you have to ask, well, why were they doing this? Why weren't they checking people? Well, in many cases, it resulted from the desire of some people to create as many mortgages as possible in order to consolidate them into what were called mortgage-based securities and then sell them off to investment funds and investment banks. On the other hand, sometimes the desire of banks to engage in this very irresponsible lending was a direct result of government legislation. There was a thing in 1995, a piece of legislation that was passed by the Clinton administration called the Community Reinvestment Act. What did this do? This forced banks to make certain portions of their credit available to what were called low to moderate income consumers. Now, such loans in themselves don't seem to have resulted in a high rate of defaults. They only constituted something like a quarter of all subprime loans. But the real damage done by this was that it contributed to a weakening of lending standards throughout the entire banking industry in America. And a weakening that was encouraged and abetted by activist groups, not to mention American congressmen and American senators who were determined to increase home ownership regardless of people's financial situations and regardless of what market rates of interest were telling them about what people actually wanted to buy and sell in the marketplace. Now the problem goes further compounded when Fannie Mae and Freddie Mac began easing the credit requirements on loans that they purchased from banks and other lenders. So in 1999, Fannie Mae began a pilot program involving 24 banks in 15 markets, including the New York metropolitan region, which, as you can imagine, is enormous. A program to encourage these banks to extend home mortgages to individuals whose credit was not good enough to otherwise qualify for loans. So Fannie Mae, America's biggest underwriter of home mortgages, didn't lend money directly to consumers. Instead, it began purchasing loans on what that banks make on what's called the secondary market. And by expanding the types of loans that it bought, Fannie Mae hoped to spur banks to make more loans to people with poor credit ratings. Now, doesn't that sound strange? Making banks lend more money to people you know have bad credit ratings. Does that sound strange? It should. It should. It's actually crazy. So, let's ask ourselves, what are some of the moral principles that were involved here? What are some of the things that were being violated? Well, once again, I think again it shows that some basic elements of prudence were being violated. First, principles like don't lie were being violated by thousands of people who were getting subprime loans. Caution was also thrown out the door in the name of easy profit and the desire to subordinate long-established lending practices and the workings of market exchange to the demands of politically driven lending programs. There was also a certain detachment from reality. Remember, I talked about that as a quality, one of the qualities of prudence. There was a certain detachment from economic reality that was going on in this situation. Most notably in the false expectations that many people had about the ongoing profitability of investments in property. I will remember in the 2000s people saying the housing market will always go up. It will always increase in value. Really? That's what some people were saying. So they were throwing their judgment out the door. It's also clear, I think, that shrewdness in the sense of being able to accurately judge economic reality for themselves was absent. It was absent from the calculations of many borrowers, many lenders, many government officials, and above all, from politicians. Now, outside this immediate realm of prudence, I think there were some grave violations of justice that were occurring. Let me give you some examples. As I said, one was the failure to do due diligence on the part of banks on potential and established borrowers. Another thing that happened was that the virtue of temperance was also largely forgotten in these circumstances. I think that the very thrifty, even rather miserly Adam Smith would have been appalled by the I want it all now mentality that helped the personal savings rate in America to hover around 0% from about 2005 until 2008. And that was the lowest rate of savings in the United States since the Depression years of 1932 and 1933. So think about it. In this period of time, in the United States, no one on average was saving money. No one. No one was saving money. So I think also that this same mindset of I want it all now encouraged many people on Wall Street who were anxious to enhance their bonus profits to sell securities that they knew were based on collapsing subprime mortgage foundations to people on what's called Main Street, who themselves were blinded by the prospects of quick profits. And we know this is true because just in the last 2 weeks, J.P. Morgan settled with the US government because it had been proven that in 2006, J.P. Morgan was selling securities to people that they knew, that first of all, they couldn't understand themselves, but secondly, that they knew were based upon subprime mortgage foundations that were collapsing before. Now, not all these actions that I've just described, not all of them are illegal. I'm also skeptical, very skeptical by the way, about the prospects of trying to prevent some of these problems in the future through regulation. Why? Well, the problem is, I think, that regulation tends to be a response to the last crisis. It's sometimes said that generals, when they're looking to the future, they want to fight the war that they fought in the past, so that they avoid the mistakes that were made back then. So in other words, we get new rules that target the mistakes that everyone already knows we have to avoid. But the next possible crisis and the causes of the next possible crisis are so far unknown. And any regulations we pass now may have no effect whatsoever or make the next crisis actually worse. I think a very good example of this is the very big piece of legislation that was passed in the United States in response to the financial crisis, which was called Dodd-Frank. Dodd-Frank was the financial reform legislation. And what it did was add thousands of pages of regulation to the financial industry, which is already being regulated by thousands and thousands of pages of regulation. So the standard response of governments to these types of problems is not to sit back and say, what's going on here? What are some of the fundamental problems driving this situation? Usually what you find is that they think if only we regulate it more, we can stop these problems from ever happening. Okay, ratings agencies and conflicts of interest. Now, as I just mentioned, the first signs of a meltdown in the subprime mortgage market occurred late in 2006. It wasn't, however, until late August 2007, in other words, 8 months later, that greater awareness of the subprime mortgage problem became much more known in the world's financial centers. Now, this is curious when you think about it, because one of the services that's supposed to be provided by securities ratings agencies, firms like Moody's, Standard & Poor's, and Fitch Ratings, etc., one of their services is to provide investors with an early warning when they think there are significant problems with a security or equity package. But here too, I think, imprudent behavior on the part of people working inside ratings agencies contributed to their failure to provide timely and accurate insight into what was going on. And I think many of these agencies more or less acquiesced in conflict of interest situations. Now, I'm sure I don't need to explain to this audience that ratings agencies derive their income from rating bonds and other securities issued by banks and governments and other financial institutions. That's how they make money. They do so by assigning an investment with a score, such as AA or AAA or A+, B+, whatever, thereby providing real actual investors and potential investors with some sense of the creditworthiness of a particular investment, be it good or bad. Now, a bad rating usually indicates that there's a high risk of default or a high risk that the security will fail. Now, given that ratings agencies are paid by the issuers of bonds and securities that they rate, it's often suggested that, well, doesn't this lead to conflicts of interest? Ratings agencies typically deny this. They point out that they're very open about the fact that they are being paid by the financial institutions that issue the bonds and securities that they rate. They also argue that their ratings are not compromised by this relationship because to do so would undermine their reputation as honest and accurate assessors. Lastly, they also point out that the analysts who work at ratings agencies are not compensated on the basis of the level of ratings that they assign to different bonds and securities. But I think the subprime mortgage fiasco raises some significant questions about the accuracy of this picture. Because from 1995 onwards, increasing numbers of asset-based securities that used American subprime mortgages as collateral were being purchased in unprecedented numbers by individual and institutional investors. Now, these securities were then consolidated into collateralized debt obligations, CDOs, and collateralized loan obligations, CLOs. Now, the risks associated with these different securities were assessed by securities ratings agencies. It's one of their most profitable activities. But here's the problem. The problem is that many financial institutions, knowing that ratings help the value of the securities they're trying to sell, they began approaching ratings agencies to ask for their advice on how do they structure these securities in order to maximize their value. But when the subprime mortgage market on which so many of these securities were built began to implode, some ratings agencies were very slow to concede that something was wrong. Some ratings agencies did start putting out warning signals as early as mid-2006, but the same rating agencies did not significantly downgrade the ratings of the very same investments. So on the one hand, they're saying, you need to be cautious about these, but it's still a AAA. Okay? So on one hand, they're privately acknowledging this. On the other hand, they're telling investors, this is a great investment. Now, the ratings agency's response to this was to say that if they engaged in significant downgradings of securities assets, this would further undermine already weakening capital markets. Now, there's no reason not to take this claim at face value. I don't think they're trying to. I don't think they were trying to mislead people. But I think it may also be true that many ratings agencies themselves became very conscious that their objectivity, which is after all their primary asset, was going to be called into question. And of course, when you think about it, the very moment that ratings agencies were asked to become involved in the structuring of the assets that they were supposed to be valuing or they were supposed to be assessing, they should have started to experience some significant moral concerns. Why is this? Because it's very difficult to provide objective assessment of risks associated with particular securities when you are one of the people who's helped to structure the very same security. But this, however, didn't deter some ratings agencies from involving themselves in structuring many of the securities which they were then rating after they were being issued. Now, I'm not suggesting that ratings agencies are somehow involved in sordid financial swindles. I'm not suggesting that. The point is that when ratings agencies were asked by banks to become involved in structuring securities, they should have said this. They should have said, no, we're not going to do that because that would compromise our capacity to objectively assess the risks associated with your securities. Our objectivity is our greatest asset. It can lend value to your assets, but only if our assessments remain objective and detached. Now, I think the fact that some ratings agencies chose to follow a very different path suggests, I think, significant failures of judgment and even in some cases of character on their part. Now, in terms of the virtue of prudence, let's go back to prudence. I think much of this reflects a major absence of the quality of foresight, insofar as any relatively clear-thinking person, especially people with enormous experience of the securities ratings business, they should have recognized the conflicts of interest that were eventually to come about from this type of situation. Now, to address these problems with securities ratings agencies, various governments passed legislation to try and prevent these types of conflicts of interest from happening again. Once again, however, I'm very skeptical that this extra regulation is going to achieve very much. In fact, I think they're likely to have some significant, unforeseen negative consequences. But what I think we should remember at the time that all this is going on, is the fact that the markets did discipline securities ratings agencies, sometimes very severely. How do we know that? Because the value of the stock in many such agencies plunged by more than 40% in some cases. So, whatever the agencies might protest to the contrary, I think that they're going to have to work very hard to regain the market's confidence in their prudence and trustworthiness. I could say much, much more about the moral problems I think that contributed to the financial crisis, and we've only really touched the surface here. But I'd like to conclude by offering you some reflections upon the institution and practice of credit itself. I suspect that you know, and maybe many of you work in the financial industry today, but even today, 5 years after the financial crisis, considerable anger and distrust continues to be directed against those who specialize in the business of credit. You only need to pick up the nearest newspaper to read about elderly couples who are on the brink of bankruptcy because they made investments that either they didn't understand or that were never adequately explained to them by their financial advisors. Now, such situations do exist, and people who have been misled or were misled by their financial advisors in the business of borrowing and lending ought to have some means of redress. In fact, they do have a means of redress. It's called the court system. Some people, however, have called for very heavy regulation of the business of banking and finance. There have even been calls, as I suspect many of you know, for official caps on interest rates offered by private lenders. Now, I think the difficulty with some of these particular approaches is that I think they reflect some fundamental misunderstandings of the nature of credit and its underlying moral apparatus. What, after all, is credit? Credit is about lending other people the financial means, the capital that most of us are going to need at some point of our lives. Whether it's starting a business, whether it's buying a house, most people need capital. This means that someone else, such as a bank or a private lender, has to be willing to take a risk. They do stand to profit if the mortgage is paid off or the business succeeds, but they also lose if the business goes bankrupt or if the house is foreclosed on. Now, charging interest is how lenders maintain the value of their loan and they make a profit, the margins of which are actually much narrower than most people realize, and in doing so they increase the sum total of capital available in a society. But interest charging is also a way of calibrating risk. The higher the risk, the higher the interest rate, in order to compensate for the greater possibility of loss. So it follows that if interest rates were imposed by government fiat, if the government said you may not charge interest rates beyond this level, lenders would effectively be discouraged from charging interest rates that are commensurate to the risks involved. Hence, they would be unwilling to lend capital to entrepreneurs and businesses that were pursuing high-risk endeavors, which means that many risky but wealth-creating and employment-generating activities would simply never occur. So, legislated interest rate ceilings, I argue, would also mean that some poor people would never have the opportunity to acquire the capital they might need, for example, to go to university, or even begin developing a credit record in the first place. I think that entire categories of people would be condemned to life on the margins. But at a deeper level, we sometimes forget that while credit is of course about money, it's of course about credit, it's also ultimately about something else that's more intangible, but nonetheless real. The word credit is derived from the Latin credere. Who knows what that means, credere? Right. It means to believe. It also means to trust. So whether it's a question of giving your child a credit card for the first time, it's one of the most risky enterprises you will ever undertake, or whether you extend a small business the capital that it needs to grow into a great enterprise, providing someone else with credit means that you trust in them, you believe in them, that you have some faith in them, you have enough faith in them that you're willing to take a risk on their insight, their reliability, their honesty, their prudence, their thrift, their courage, their enterprise. In other words, all the moral habits without which wealth creation simply can't occur. Now, when you think about credit in that way, I think it reminds us that what we call the free market economy, which is often so viewed as so terribly materialistic, it actually relies very heavily upon a web of particular moral qualities and non-material relationships. And as I think the 2008 financial crisis should remind us, once these things become corrupted, whether by basic dishonesty, excessive regulation, or political manipulation, the wheels of wealth creation splutter and eventually they grind to a halt, which means that businesses die, people lose their jobs, and people suffer. But let's not make any mistake. I think that the modern case for the free market, one that I very much believe in, but which has been painstakingly developed against interventionists of all stripes since the time of Adam Smith, I think also the modern case for this, as well as the case for banking and finance, has been put back years as a consequence of the 2008 financial crisis. The very same calamity, however, should remind everyone of a very, very important truth. And that truth is this, that if you're going to loosen the political bonds on economic liberty, then you have to ensure somehow that society's moral bonds are being constantly renewed and strengthened. In short, I think today we're learning the hard way that virtues like prudence, temperance, like thrift, like promise-keeping, like honesty, like humility, not to mention a willingness not to do to other people what we wouldn't want them to do to us, these virtues, these values, cannot be optional extras in communities that value economic freedom. If markets are going to work and we're going to maintain significant limits on government power, then society requires substantial reserves of what I call moral capital. Because with so many people's economic well-being now partly determined by those people who are working in the banking and finance industries, sound moral character, sound judgment in their employees and directors should be a premium asset that's sought by any bank or financial house. Now, I happen to think that virtue is good in itself, and we ought to pursue it for its own sake rather than simply a question of economic efficiency. But that doesn't mean we should close our eyes to the very real economic benefits that I think flow from large numbers of people embracing the virtues. I think that would be a culture-changing exercise. Because in the end, no amount of regulation, be it heavy or light, can substitute for the type of character formation that's supposed to occur in other institutions of civil society, families, schools, churches, etc. These are the institutions that Adam Smith, by the way, identified as primarily responsible for helping people to develop what he called the moral sense, that allows us to instinctively know when particular courses of action are imprudent or simply wrong, regardless of whether we are Wall Street bankers or whether we are humble people taking out a mortgage for the very first time. I think it's significant also that at the very end of his life, Adam Smith added an entirely new section entitled Of the Character of Virtue to the sixth and final edition of his theory of moral sentiments. Now, his reasons for doing this have been heavily debated. But I think that maybe Smith decided that as he glimpsed a world in which the spread of free markets was already starting to diminish poverty, that he needed to re-emphasize the importance of sound moral habits for societies that aspired to be both commercial but also civilized. And I think that is surely advice that it's worth us heeding today. Thank you.